All right, back at it again. The next video, reason 4 and reason number 3 are coming your way in a sec here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate because that's just what I do. All right, so as I said, back at it for the top 10 reasons why we will have another housing crash and crisis. Let's review what we've talked about the past couple of videos. The reason number 10, banks, lenders, and servicing companies have been preparing for this. Number 9, the Mortgage Debt Relief Act is back in a different and better format. Number 8, investors are leaving the market or waiting, both from the international investor and the domestic investor side. Number 7, the current housing narrative and the fact that government wants to, for whatever reason, be in the real estate game. Number 6, last video, was the home price appreciation, along with delinquencies, forbearance, and foreclosures. So what are we going to talk about today? Well, we're going to talk about the fact that data providers and others are discussing the housing bubble and the potential foreclosure volume. So yeah, this is actually happening, people, as much as not everybody wants to believe it. Well, when I say the data providers and others are discussing the volume and the bubble, this is kind of another cross-pollination, cross-occurrence reason here, because obviously we spoke, it's a nice segue. We spoke about the forbearances, the foreclosures, the delinquencies, the last video, so it kind of works its way into this one here. So, but who are these other peoples, you might say? Well, real estate analysts, economists, real estate gurus, CEOs or ex-CEOs of companies. We see more industry journalists talking about this on their websites. We see various regional, Fed executives, New York Fed, Dallas Fed, whatever, St. Louis Fed, talking about the economy, talking about issues with the interest rates, talking about how housing is becoming out of control. Groups like the Urban Institute, American Enterprise Institute, stuff like groups like this. A lot of it also revolves around being very critical about the Fed's policies on how low interest rates are stimulating and and contributing to the quick increase in housing prices. Also, the fact that the purchase of mortgage-backed securities by the Fed is further fueling the marketplace as well here. And now they're recently talking about tapering that off and raising some rates that hopefully that'll cool down the housing market. So there's just a lot of discussion going on, and it's actually becoming interesting. But we're seeing more and more people kind of going, hey, they're not waving the flag. This is a fabulous market. Nothing's going to happen. Now they're throwing some shade on it and saying, listen, we better take a look at what's happening here, or there's going to be problems. So, but my point though is that this is a positive thing. At least we are discussing this. This is, it's out in the open, and it shouldn't come as a surprise, regardless of how bubble theory works and how people are buying into the housing bubble concept. At some point in time, things have to change. All right. Now, why this is different this time around, in quotations, I mean the data thing and how we're aware of it, because we didn't have the detailed data before, right? Real estate was, again, 2004, 5, 6, 7, 8, I can tell you that I think I got on Facebook in 2009, and I got on Facebook for business and to do what I'm doing kind of here then. So I guess, we didn't have this detailed information before. We didn't have the data coming to us almost on a weekly basis, a monthly basis. We basically were looking at, real estate statistics in your local market a month or two after the fact, seeing, housing, inventory, seeing prices drop, seeing foreclosure sales, whatever. So a lot of this we were learning on the fly. Now we're almost real-time data. We're getting real-time weekly foreclosure. I can get daily data of foreclosures and see what's happening on the auction block. We're getting, weekly forbearance data and things like that. So we're getting weekly mortgage application data. So I can tell you that mortgage, refis, are up when lower rates are there. And right now we're seeing purchase data dropping. All right. So it's almost on a real-time basis. We didn't have the medium, the medium being the internet as strong as it is, having, Facebook, Twitter, YouTube, all these other websites, webinars, things like that. So we didn't have the medium to show everybody all this, nor did we have the interest in housing, because we were going through bubble number 1, and then we had, the boom, the bust, the crash, the crisis, and things kind of, will unravel from there to see a whole other realm of, distressed buying, opportunistic hedge funds, iBuyers, more mortgage companies, all sorts of, more, you could say financial tech, fintech, stuff like that going on out there. So it really has been a different ride over the past 10 years. So I got to say, it's been a lot's happened in a short period of time. So a lot has changed, but realize that we're more aware of things now, or we should be, and there shouldn't be any excuses. So why talk about potential volume? So as I mentioned, we talk about potential volume of foreclosures, and that's kind of generic. We talk about potential corrections or I guess you could say decrease in housing values, price points, whatever. We'll talk about this. Why? It's to drive traffic, right? We want to gain views. Listen, I'm here for that reason as well too. We want to gain views. You want site visits. You want people to attend your webinars. You want to promote and sell your products and services. You want to get people to attach and follow you. That's what we're all about these days. But also, it's a roundabout way to warn us as to what's going to happen out there. And I mean, I take these warnings very seriously, as you know, and as I've mentioned many times, one reason does not cause a housing crash or crisis, right? It's the culmination of a number of things going on in the industry that will cause the industry to be pushed over the edge. So that's the whole point here. So I want to get into that and make sure everybody realizes it's not just one thing here, but when you add it up, we're talking about this now, we're talking about it in a way we never spoke about it before. So that's why it's interesting and it's educational, but it's also telling, and we should heed the warnings. All right. I'll go back to this slide I use quite often. This is from Adam Data Solutions. This was a webinar that I attended back in the fall. I forget, it was in November timeframe. They actually ran a couple of them, and it showed it was auction.com spot. Well, that's one of their Adam Data companies, but they were talking about look at the completed foreclosures over a 4-year time frame, 1.8 to 2.3 million. Then through other discussions I was picking up on these guys, they thought maybe 2.5 to 3 million. You see, so I guess that's what's been going on. So people were talking about this. Now I'm going to mention, though, it's been kind of quiet now. So the past few months we really haven't seen statistics like this being thrown around, just because I think everybody's just kind of waiting patiently to see how it's all going to play out. And what I mean by funny math is that people are taking the forbearance numbers and trying to extrapolate, well, the current people that were in forbearance but now are in the foreclosure situation, and let's take that percentage times who's left, and that's your potential foreclosure volume in the future, which is off, because the people who are in forbearance still are the ones that are actually needed the most and don't have solutions, or they're not working for them, essentially. So they're the most exposed ones. So the point is, we're all trying different ways of figuring stuff out, doing our math, okay? And math in public is dangerous at best. But my point, though, is that this is discussed, okay? Other, national mortgage news here. I have a subscription to this. Basically, a couple weeks ago, mortgage distress expected to climb after forbearance ends. So you can see that, sort of behind the scenes, there's general sentiment that, what the narrative is, I've spoken about in a previous reason, that, all this equity is not going to solve all these problems. And the expectation is we're going to see some significant numbers of foreclosures hitting the docket as time goes on. So people are going to, come out of forbearance. Some are going to try loan mods. Some of them are going to go into loan mods. Some loan mods are going to fail. Some won't get loan mods. They're going to go to the foreclosure bucket. All right. And then that process will take place based on the location in your state, foreclosure policies and laws as to how fast you're going to fall in onto foreclosure. So the point, though, is that, again, people are talking about this, and it's another warning here. This comes out here, most vulnerable counties to foreclosure. We got Jersey, Illinois, Florida. Illinois, again, 33 of the 50 most vulnerable counties, including 7 near Chicago, around New York, and 5 in southern Florida. You know what I mean? So it's just kind of like Connecticut, Florida, Illinois, Jersey, North Carolina. So we're the players that were there before are happening again. So all this is going on. All this information is available. But are we looking at this, as a singular individual instance and article? Or are we putting it all together to say, hey, cumulatively, we're setting up for having some problems here, and that's kind of how I look at this. Zombie foreclosure spike in second quarter of this year could be start of a new upward trend. So it's not the fact that well, I guess it is the fact that we're having these foreclosures. So that means a number of things. It means foreclosure starts are picking up. It means people are actually looking at this. It means it's not a disregarded situation like it's been for the past year. So things are changing, and now as we approach that sort of critical inflection point of forbearances releasing, coming into the month and come the next couple of months, we'll see what will happen. All right. Look, even Bankrate puts out stuff. 40 cities that could be poised for a housing crisis. They do this periodically. So, and here you go. What do you see? You see basically foreclosure. The first thing it shows on their website is foreclosure. How's the foreclosure sale sign? So, it's not just, I guess you could say there's lots of other groups and people that are saying, hey, let's start talking about this and let's sort of figure this stuff out. So I guess that's what I'm seeing. That's how I read all this going on in the industry. Yes, there's Darren Bloomquist again. I use a slide quite often, auction.com, promoting the fact that short sales and other pre-foreclosure sales are poised to become more dominant share of the distressed market this year going forward. And I can tell you that is happening right now because I've looked at a lot of stuff and I see a lot of things happening, at least in my local market here in Florida. This is interesting. You have a CEO, the former WAMU CEO, which is Washington Mutual. And I don't know if you remember Washington Mutual back in the last housing crisis. They were one of the biggest, if not the biggest, actual lender to essentially self-destruct and implode with respect to what happened in the housing crisis. So this guy is basically talking about, former WAMU CEO sees a housing bubble forming because the Fed is hooked on low interest rates. So, is he coming a bit late to the table? Yeah, there's probably a reason why he's being interviewed here. But my point again in this is that people who have gone through this, people who have seen this, people who have experienced in the last housing, boom, bust, crash crisis are now chiming in going, hey, things aren't as great as you'd like to believe, or we'd all like to believe. We should start peeling back the layers and seeing what's going on here. So some of his quotes, which are interesting here, there's three of them. Some of the policies currently being adopted by the Federal Reserve and the regulators and government may be leading us to a new financial crisis. The Fed has gotten hooked on these expansive policies of ultra low interest rates, asset guarantees, asset purchases, and flooding the system with liquidity for a long period of time. And right now you have borrowing costs substantially below the rate of inflation and way below historic norms, and that's unlikely to last forever. So that last, they're all good quotes and they're all, they all mean something, especially the fact that borrowing costs are below the rate of inflation and below historic norms, and that's what's fueling this situation here, but that cannot last forever. So that certainly is important to know. And when you take a look at where some more discussion here, some of his discussions or his quotes are these that says here, and these growing asset bubbles just continue to escalate to the point to where the assets are selling well above reasonable estimates of intrinsic value. That always presents a certain amount of risk. And finally, we are seeing more and more speculative products and speculators in the marketplace, not necessarily just in housing. So it's sort of, it looks like all asset classes are seeing this, but, housing is included in there. And at the bottom, basically, it's like, a fair bit of that buildup of buyers for those single-family homes or pension plans doing it directly to have that asset category. Because with the Fed keeping interest rates artificially low, they can't afford to put into reckless assets like Treasury securities. They have to keep searching out yields. One of them is increasingly into residential real estate. So what they're basically saying is that this is where the money's going because at least it returns. Treasury securities really don't. Real estate does. It's tangible, etc. So, money is going here, and that's sort of what's fueling the bubble, and that's just sort of, number one. But number two, the next thing I'm going to talk about, you'll see how that, they're also being poised to take advantage of that. But so the point to all this is that it's not just me. Okay, not just some dude who, does a bit of real estate here and there and is giving you, a little bit of insight as to what I've experienced for the past, decade plus. We're talking very well-educated people, PhD degrees, CEO of massive companies, people who've done, billions and billions of dollars of the transactions are sort of raising the flag saying, there's stuff that's going to happen here, and we best be prepared for it. That's the read between the lines situation here. So, but first of all, if you're not already a subscriber to my channel, if you could please help it grow and smash that subscribe button, I would really appreciate that. And secondly, if you think you're a subscriber, if you could just try to resubscribe, please, because I've been losing subscribers at a quick pace, and that's part of the whole process here. So smashing that subscribe button either way would certainly help me, and I appreciate it very much. So thank you. All right, guys, next reason three, it's all coming together now. So reason three as to why we're poised to have another housing crash and crisis is Wall Street and others are waiting for this to happen. Is this kind of like a preordained thing? I have believed this since 2013-14, when I saw the hedge funds come into play, when I saw them buying out of the trough, when I saw how the market was being manipulated and how low inventory was already in place, and the assets or the distressed assets were being controlled and not brought into the market, which we've spoken about. So yes, Wall Street and other big investors and other people involved behind the scenes are poised to make a lot of money. So Wall Street is waiting for this to happen. If we revisit the last housing crisis, the previous housing crisis, my biggest takeaway from it was the amount of single-family residential assets the institutional investors, the hedge funds, other large investor groups purchased during that time frame. They purchased tens to hundreds of thousands of single-family residential homes. All right, they bought them at the foreclosure auction. All right, they went and they bid at the auction. They bought them from wholesalers. They bought them from short sales. Okay, guys like myself, we sold a number of properties to a lot of these groups because they're ready, willing, and able cash buyers. Third-party auction sites. You had all these, auction.com came into play. You had a few of these auction sites that are out there that were created by the servicing companies and lenders and things like that. So they were buying there as well too. They purchased a lot of what we call non-performing NPAs, non-performing assets via pools. And we're not talking buying a property here and there. We're talking buying $500 million. $1 billion, $1.5 billion worth of non-performing assets, of all these foreclosed homes from banks, lenders, government-backed groups like Fannie Mae. I mean, Fannie Mae sold off tons of, I guess you could say, of assets that they had guaranteed in the last housing crisis, and they don't sell them off, for 2 or 3 properties. They sell $1 billion, $500 million. $1.5 billion worth of assets to these hedge funds. And the whole point, though, is that when they sell it to these hedge funds, they don't come back in the marketplace. So the way it should work is that, we're the asset holder. We're going to put them back in the retail market. They'll be on the MLS. You can buy them, etc. The whole bit, right? More inventory pushes prices down, more affordable for everybody. But no, they didn't do that because it's much easier to go to a ready and willing buyer who can just take it all out in one fell swoop. And what these guys do is they convert them into rentals. They may do fix and flips and put them back out in the market as high retail products, but primarily they're cash flow rentals. They'll rehab them to the extent they need to be rehabbed, and they're now cash flow rentals. They'll be offering rental homes to the masses out there. But the thing is, they're not coming back in the market as inventory or lower price inventory where we have the benefit of that. That's the whole point. So Wall Street likes this because basically everybody that was foreclosed on or had a short sale happen last time through is now their new client. That's their new potential client for their rental performing assets, you see. So that's how it kind of works. So that's that's kind of my perspective here. So obviously I've used this slide a number of times. The single family rentals become an asset class. So everybody wants it. This slide even goes a bit farther. Operators are even competing for land. So right now they're not buying as many of these assets because they're too expensive. So what they're doing, they're buying land, and they're now working with home builders to actually build 50, 100 home neighborhoods that are just rental neighborhoods, simple as that. So they'll find a way to deploy the capital, but as I said, they want the foreclosure stuff to happen because they know they can jump in and they can purchase it. So how do we know this? Well, this has been talked about. This is a year old from last year in April, but real estate investors eye potential bonanza and distressed sales. The whole point of this article is basically saying that A growing number of property investors preparing for what they believe could be once in a generation opportunity to buy distressed real estate assets at bargain prices. Yes, that's the opportunity that's basically coming in the next month or two. Okay, investment firms like Blackstone Group, Brookfield Asset Management, Starwood Capital Group are sitting on billions of dollars in cash and capital commitments they have raised from pensions, sovereign wealth funds, other big institutions in recent years. So yeah, if you delve deeper into articles like this, you will see that there are literally billions and billions of dollars of money, as they call dry powder, waiting to be deployed into the residential real estate field, and they can't wait. So how are they going to buy? So do these groups buy at the top of the market? No, they buy distress. So that's why they're not going to spend until we go down that distress pathway, and that is going to happen. So this is all, as I said, all preordained. It's all going to happen. It's the whole process. Now, I've used this slide before. This is the slide that I like to show about the mom and pop small investors who have a lot of the rental property. So we're talking 1 to 10 units. 88% of the single family rental markets is held by smaller investors. About over 19 million units are available or under this sort of category. So do you think that they don't want this to happen? They sure do. They want to go after this group because this is the group that has all the assets. This is the group, besides the normal residential primary home people that are going to lose, this is the group that doesn't really have forbearance, doesn't have protection from the government, that try getting, I'm working through this for a client right now, trying to get them funding through these government, we'll call it, the stimulus money that came in, and then what they earmarked for rental assistance for renters and landlords. And it's not like you can just get it. You got to jump through hoops. You need participation from both parties, and not every party wants to participate, right? So this money that's been earmarked, a lot of it's just never going to end up in the hands of people who actually need it. Simple as that. So this is the group that's going to take the loss. And as I said before, that this group essentially is the target. Okay, that's the target. This is where we're going to see a lot of the carnage, and that's what we'll say Wall Street's happy with. Okay, simple as that. They're prepared for any amount of foreclosures. As I said, they've got all the dry powder. It's billions and millions to deploy. They're ready and willing to buy. They can outbid smaller investors at the local auction. Why? Because their return on investment and their cash on cash requirements can be less than others. Like, for example, if you're going to buy a property, you need to buy it at a certain value, and it's got to return maybe your 15% or 12% cash on cash. Whereas, and your cap rate has to be X and whatever. Well, these guys might not need a double-digit cap rate to satisfy their investors. They might be happy with a certain cash on cash return that's lesser than you, because they're buying in such bulk, and they got their investors who are saying we're happy with 6%, 7%, 8%. You see, so that's the situation here. So ultimately, in the end, why Wall Street wants this to happen? Because they're converting us into a nation of renters. All right, that's part of the government's plan. So let Wall Street step in, buy a lot of properties. Let's let them buy it. Part of the government's long-term plan, I believe. I think you'll see some partnerships going on here that we can't even envision right now. But my point though is that everyone seems okay with this. Like, no one's complaining about this. When the little investor has issues or does something, they're targeted, and no one's supporting them. But when Wall Street comes and just fell swoop and wipe us all out, nobody seems to care. So again, that's why we have to be prepared for this. That's why knowing this is half the battle. Knowing your enemy is the other half of the battle. We can get deals ourselves and become mini hedge funds if we want to, and we can supply them with deals as well too. So we can work both angles here. That's the whole plan going forward. That's at least what I'm trying to do. So the point here, as I said, is that it's time, all right? And why is it time? The end of forbearance approaches. Foreclosure auctions are coming back on track. Some of the backlog now in many states and counties. Foreclosure filings and foreclosure starts are increasing. That will increase very shortly. This is where to look for deals. More will be available than predicted. We're not seeing the true numbers, but investors are already in pursuit of these. I'm seeing this right now as I'm going through data and things of how I'm marketing and what I'm trying to get my hands on for my clients and myself. I see people are out there as well too. So this is, so I guess the point is, why, like, it's happening now. So don't wait to the moratoriums go over, whatever. Get in now, because everybody else is, like, it's starting. That's my whole point. It's really starting. And why do you want to do this? Well, I'll give you an example. So I use this slide quite a bit as well too here, and I just got the updated data today. So I put it in. So this is the Tampa Bay, Tampa, St. Petersburg, Clearwater, MSA, and this is the single family homes for the month of March. This is the most recent comprehensive data. You could see that the median sales price for a traditional sale is $300,000 for the month of March. It's $190,000 for short sales done in the month of March. So that's a difference of 37% discount, $110,000 an equity difference there. So this is the reason why you want to do short sales. Obviously, what was okay for REOs, there's about $80,000 in REO, our REO equity there, but short sales are even more. So when I say that, this is where the action's at, the distressed property, where the action is at, can you compete with the big guys at the foreclosure auctions? I don't know your cash position and your appetite for that. Can you compete with short sales? Yes, you can, because no one's doing the business. Look at only 12 closings in March that were short sales, and look at the difference in price points. So this is where the opportunities are. You need to be jumping on this right now. And again, that's the reason why. That's why people are doing this, because when you look at distressed properties, even though we are at high retail values the whole bit, distress gives you a discount. Distress gives us hope. All right, I guess that's my point here. The distressed property market is the one place we can find hope and solitude, that if we can actually participate that, we can get a better property cheaper, and we can do investing cheaper and things like that. So how many are distressed? Well, this is that number that I spoke about last video on on the foreclosure forbearance side. We're all over the place, right? Black Knight on the forbearance side is talking 2.2 million. Adams 3+ million. Yahoo via CNBC talks about 4 million. The White House states 10 million adults in the households not paying their mortgage, but we sort of debunked that a little bit. I'm thinking 5 to 6.5 million minimum. Many people are quietly predicting, I hear behind the scenes, over 10 million, which is like the last housing crisis. Simple as that. I've heard 10 and 11 million talked about openly the other day. What we're not really talking about is that small wild card amount. So I think if we're talking the 10 million, then that landlord wild card amount's got to be included in there. But that's something that we're not, that's not even factored into these other discussions, that amount. That's where we're going to see some carnage for sure. So anyway, that's the scoop on that. So how do you get involved with me here? Very straightforward. This is kind of what you want to do. Again, I've got that's the number one deal you should be involved with right now, because that's gets you ahead of all these investors and into the game as real transactions. You can do this with no money down. It's a real estate transaction, nothing out of your pocket if you do the right system. Okay. Also, I'll tell you about it. Just connect with me, Randy@luxuryshortsales.com. And once again, if you want more information as to what's happening in your neck of the woods to actually see these distressed properties, go to gethousingdata.com for my partnership with Foreclosure.com, the number one provider of distressed property listings in the U.S. So you can check them out there, gethousingdata.com. And by the way, as I mentioned, reach out to me, all right? I know people have reached out to me, and we're sort of going back and forth. And I guess one of the sentiments that I've seen here is the fact that people are saying, I'm going to wait until the foreclosure moratoriums are over. Don't do that. Start now. That's why I'm saying get involved now. Connect with me now, because that's 2 or 3 months too late, and people are already jumping on those deals, all right? So you got to be ahead of the game, all I'm trying to say here. But once again, guys, thanks you for the views, likes, comments. If you're not already subscribed, subscribe. Please share the video with your family and friends. And we'll be doing another video in a couple of days to finish off this series. See ya.